and we'll kind of hop into some information here. But while we before I jump in, I do want to just start with the question of like how have things been going for you so far this year. We're getting into what is it, Q4 now? Um, Coming out of the summer, mostly the high season for y'all. It's been a pretty wild year. I've been doing a lot of these and seeing a lot of data. It's been pretty interesting. So I'm just curious, how do you guys think the year has been for you so far, and what are you thinking about coming into the rest of the year? Anyone want to jump in?
I'll jump in. I think it's been a challenging year. I think that, especially for our market, I feel like it's a blue collar market and they've been hit harder by the economy than any other segment. And so I feel like, we've really had to work really hard to get what we have.
Yeah, I would agree with that. I mean, I think, usually the summer, the demand is just so high and I mean, it was still high, but I did got the sense that we really had to fight for every room in some cases, which was tough. And I would say in general, though, we're seeing a real variance in difference between weekdays and weekends. Our weekdays are just not performing as they have in prior years. And I would say we definitely had a slower September, mostly because of the weekday situation. And of course, the last weekend in September, we had, last weekend was rain and then possible Imelda, which caused us an issue, spooked people. And then heading into fourth quarter, I would say we're very concerned. I mean, all of the things we're seeing are, we're definitely pacing behind. So overall, I would say our portfolio has performed better than the overall market in Myrtle Beach, but in terms of versus last year data, we're still in general performing behind with a few exceptions.
That makes a ton of sense. Thank you, Laura. Would anyone else like to jump in terms of what they've been seeing or experiencing throughout the year?
Yes, I'm in North Myrtle Beach. This is Sarah Black, and I do marketing for a company there. And what we've been seeing typically is last minute bookings as compared to several months ahead of time, shorter bookings, but we've been getting weekly bookings through the summer instead of the 7 nights. It depends on what we have for minimums, but September has been down, perhaps some of it because of the storm, but it was down before then for bookings, which we typically would have had ahead of time. And so we're just hoping that next year is going to be better and different.
Thank you. Really appreciate you sharing that. Definitely understand that sentiment. Did anyone else want to pop in?
We had pretty good numbers here in the Outer Banks. Our company did well. Occupancy was, pretty spot on with last year. Revenue was up a little bit, so it's been a good year overall. Numbers are looking a little lower for next year, so we're kind of looking to see what we can do about that. This year, our booking window shortened a little bit. We thought it would be a little bit more drastic than it ended up being. So that was good, but it did lower a little bit, and so we're thinking that trend might continue for next year as well.
Yeah, that's interesting. Do you generally have a pretty strong booking window?
Yeah, I mean, generally when I've been on these calls and at Darm and stuff like that, the Outer Banks in general, it's just a little larger booking window than some of the other markets with the shorter rentals and stuff like that. But yeah, here in the Outer Banks, we have booking windows, if it's usually above 200 days for a lot of our properties, especially the larger ones. So we were concerned it would be lower. August was looking a little rough when we started to look at it, last year in December and stuff like that. But as we got into the year, it ended up, rebounding and we ended up with a little bit better August than last year even. So good year overall, and we're just looking to try to sustain that through next year.
Yeah, I'm sure we'll ask you some more questions, Jason, because I think a lot of people would like to be able to report that. I'll give you guys some kind of national trends that I've seen, like markets. Um, just so you have an idea of kind of what maybe is going on around you as well. Most market and leaving ski markets out, they're a little different, have a little different situation. And take this with a grain of salt because it's not every market, but most markets were doing pretty good at the end of 2023. For 2024, early booking was looking pretty strong. Advanced booking in the short-term rental industry was generally ahead in most regions. There were a few indicators there that it wasn't just going to be great. ADR for that early booking was lower, so there's a mix there. People were purchasing at a lower point potentially. Um, Also, there was some hunch that really, professionals driving this were being more conservative about the year than they had in the past. But occupancy was pacing was higher at the end of the year. That was reported on at DARM and VRMA, primarily by key data. Um, January, February, low season for most people, but actually performed fairly well, and that booking trend continued to be pretty strong coming into the year across most markets around the country. And then pretty much across the board, once we hit March, almost all the, major vacation rental markets start to see pressure in March. Some of that can probably be attributed to Easter shifting quite a bit, but by the time we get into April, we don't see that Easter like recovers the losses in March for most markets around the country, across the Panhandle and the Gulf, all the way up um, to, New England. Now, some of these markets aren't going to have as big of time periods in the March, right? I think you really hear about it around the Gulf because they tend to expect that period to be pretty strong. I think there's some bumps across the Carolina coast, especially more associated with the Easter, less associated with the spring break. But it's not quite as strong as you see in the Gulf. But pretty much every market that we start to see, we see pressure. That pressure through the spring on occupancy at a market level kind of continues pretty much until the summer. And that's where you start to see things split a bit. Some markets start to recover their occupancies for the summer, some markets don't. So, like across the Panhandle, a lot of markets actually recover their summer occupancy. They start to come out of that trough that they've had in the spring. We'll take a look at what's going on across the Carolina coast. If you go a little more inland, like uh, the Smoky Mountains and stuff, they're kind of mixed. And then if you go north into New England, they just remain low. They remain having like pretty big occupancy shortfalls across the summer. So the situation gets pretty mixed across the country. The West also fairly mixed. You have like some that recover a little, but for the most part, they're still continuing to see shortfalls across the summer and their high season. Get into around like probably like early August, we start to see some pacing problems though for the fall. So in early August, as I'm talking to folks across the Panhandle, across the Southeast, generally what they were saying to me and what I was seeing in the data is that pacing for the fall was looking pretty good. But around first half of August, it starts to flip, where now pacing starts to like fall behind a little bit. And most people I've talked to and most of the data I've seen, September has been pretty bad, pretty much across the country. So a lot of weakness in the marketplace in September. We see a few other things that happen too in August. Smith Travel Research held their conference. They actually reduced their forecast for the year on the hotel side nationally, which made pretty big news. I thought that was pretty interesting. So it wasn't just us in our data seeing like, hey, September suddenly seems really poor. October was pacing ahead. Now it seems to be kind of on the cusp. In the hotel world, they look at the nation, they say we're reducing our forecast, right? I do have a little bit of information on that too. Obviously, hotels are not exactly what we're doing, but they have really good data, particularly at a macro level. So I do like to follow them. They have been reporting that pretty much consistently since July. Things have been down in the hotel world at a national level. They continue to see this pressure. There's a lot of differences between markets, but at a national level, they see consistent down weeks. This goes into around this time in August is when they're adjusting their forecast, and they're reporting that basically they're expecting things to not be favorable through the end of the year for the hotel world. This is an article, and I'll send you this after if you do want. I like to pull some other articles up just because they if you as you're talking to owners, it helps to have different sources of information or talking to your own executive team to kind of support what you're doing. This is CoStar. CoStar owns Smith Travel Research. They're probably one of the largest real estate data providers, maybe in the world. This is also their August performance, which just shows that August was down nationally. This one's a pretty light one. It was just a press report. But we see that something changed around August for the fall. I think that things looked fairly positive coming out of summer. Didn't look so positive as we got to the end of August. Most people I've talked to who've gone through September have seen that to be pretty weak overall. And then, you know, the question is, how's October going to do? I think in a lot of the Carolina coast markets, except for like cities themselves, October and the fall are not quite as strong, so the expectations there aren't quite as strong as like what you would expect in the Gulf, where they have this like whole fall break season and a little bit of a bump from like some concert stuff. But even in like urban markets, we're seeing things be pretty weak. And something you mentioned earlier, Laura, is really, really interesting to me, which you mentioned that the weekday weaker. That's something we have definitely seen, or I have seen across urban markets in the South. So like Nashville, their occupancies are down consistently across the board. It's primarily driven by weekday occupancy, right? Even in the downtown where people were maintaining like an 80% average, they've just lost all their weekday occupancy. So the weekends are still there. The weekdays are weak. We see the same thing in like Savannah, especially in the short-term rental space. Those weekdays that were really bolstering occupancy in the years post-COVID have kind of gone away. I don't have a good picture of how that works in the short-term rental space because people tend to be more restrictive. We have these different homes, but I have heard that that weekday occupancy situation is lower, and a lot of people have talked to me and reported about how they're just getting shorter stays. They can't hold their restrictions near as long. And that is something that I think is kind of interesting in this area. Because at the beginning of the year in the spring, something I thought I was hearing from around particularly the Outer Banks, a little bit in Hilton Head and Myrtle Beach was both a need and a willingness to start dropping restrictions earlier than the market had previously had to do. Is that something you guys have had to do in your portfolios to price manage?
I think things are trending that way. We at least need to be creative and be willing to do that if we see certain weeks, that are not pacing as well as others. I think we definitely, the old rules, like you said, of, the 7-night stays, really, really tough unless you have a really big unit. Then you may be able to get away with it.
Yeah.
Yeah,
Yeah, I
we're
think
kind of a unicorn here in Myrtle Beach. We don't have nightly minimums, and so we're just kind of. I think it's very uncharacteristic of this whole market because it's such a legacy market and it's been that way forever. But when we just had decided that early on, average stay lengths were getting so much shorter, it didn't make sense to have a 5-night minimum if the average stay length was 4.6 nights. So we made the decision early on to not have nightly minimums.
Interesting. Do you think that's been pretty successful so far or helped a lot in this environment?
I do. I think it's one of the ways where we've actually been able to hold what little ground we had was because we can do 1-night, 2-night stays. And it was a great way to fill gaps in the spring and the summer.
Awesome. Jason, I saw you were going to speak too.
Yeah, it's just some we're lifting restrictions, stuff like that, more so on like the shoulder and off seasons, just helping us kind of boost those. During COVID, we were really successful in those shoulder and off seasons more so than other years. So now to just try to hold on to that success, we've been lifting some of those restrictions, and then also for some of the smaller houses or some of the 3 or 4 bedroom houses where there's just a lot of competition and a little less demand, lifting those restrictions and just changing things, getting more creative about what we can do to get those bookings, rather than just straight drop the price. Whatever we can do kind of gives us more options. It's been working.
Yeah, I think that makes sense. I see it as like kind of having this view of talking to folks all over the place. I see it as kind of a trend that a lot of revenue management trends kind of start around the Gulf because it's so dense and there's so many like revenue managers competing, and they really eroded their restrictions years ago, right? They tore started really truly across the market tearing off Saturday to Saturday restrictions and longer stay restrictions a couple of years ago when they saw like slight pressure, and had even started that well before, right? And I kind of see that the pressure that people kind of saw last summer, like not this last summer, but the summer before, a little bit across the Gulf. Now that more people are seeing in the country, we're starting to see them also adopt pulling off some of these restrictions. So I kind of see it as a trend that we'll see more and more companies kind of strip off those restrictions. It doesn't mean across the board, right? Like Jason said, shoulder and off season, like the timing of it is really important, but I think that that's something that we'll start to see be more adopted kind of as a standard next year, which is probably good for the market. It does require some kind of conversion. You have to do some stuff with your rate plan around that. Usually when you have a shorter length of stay, like you do need more of a dynamic price because you want to put the revenue into the dates that are most likely to book if you're not going to require them to book a bunch of extra days, right? So you see people have a little bit different prices on different days. You'll also have to find like what the sweet spot is for your particular portfolio, what your particular unit type, right? Because if you have big homes that are consistently selling at long stays, you probably do want to restrict them, or you at least can restrict them. But I do see that kind of trend of like some of these things that have happened in the Gulf over the last few years where they have been adjusting. They seem to be spreading to areas that I hadn't quite seen as much willingness across the market to do that. Awesome. Well, I'm going to dive into some market data here. Did anyone else want to comment before I do?
I do have one question for you, John. With what you're looking at here, what you're showing us, and the number of listings, what exactly is feeding in to this? I mean, because I'm not very familiar with Wheelhouse. So is it hotels, only vacation rentals? Is it, can you give us an idea about that?
Sure. Yeah. So I have pulled up here one of the Wheelhouse market reports. This is going to be our like really high level view. So we are just looking at vacation rental data. It is a mixture of our direct data. So all of the direct data we're taking from our clients, just so you know, we are like the primary enterprise client. We work, Picaso's portfolio is actually fully live on our system. We work with Avant Stay. We work with some away day sites. A lot of the big enterprise clients work with us. So their direct data goes into this. We see that in here. We also use our machine learning model that has been around for over 10 years now to kind of estimate the gaps using the scrape data. It's a benefit of scrape data. We work with key data as well. So this is kind of our view of like the top level, and it does include quite a bit of actuals in terms of what we're looking at. I guess that's the answer to the question, right? We do pricing as well, so we have some other things going on. This is a data platform that is free, so you can see that this is a pretty broad area. We're going to look at some pretty broad areas for trends right now. The model is going to be much more granular when we're doing pricing, and we do have some other data tools that let you dig in a little bit closer. Okay, so I've got a bunch of these pulled up. We'll start with the Outer Banks and we'll go to Myrtle Beach, and then if we want to, we can hop into some other places. I did pull up some trends on the back end and do some calculations as well, and a lot of the trends across the entirety of the coast look pretty similar. with maybe the biggest difference being Myrtle Beach itself, actually. So if you want to access these on your own, let me find my pen. There we go. If you log into Wheelhouse and just create a free account, it's just under this market reports. You can search for any market report and access it. I'm going to hop over here to the trends section first. This is a spot I like to just hang when doing kind of top end trend or, analysis. And I kind of recommend to people that they do what I would call like a strategy analysis, like at least once a quarter, where you kind of are just looking at these top end trends and trying to answer the question, like, where do I think the market is going, right? Do I think it's getting better or worse? And then usually I suggest people come up with like 2 to 4 bullet points that you can use to explain to your team what's going on and potentially to owners, right? To really simplify that. And generally speaking, I'll look into a lot of data when I do something like this, but when I share, I tend to use an occupancy chart. I think an occupancy chart is an excellent chart to explain to people who aren't necessarily a revenue manager what's going on. It's simple. Most people can read it, and the answer is usually pretty clear. If occupancy is up, things are probably going pretty well. If occupancy is down, things are probably weak. And sharing what's going on in the market and sharing what's going on in your portfolio can be a good way to illustrate or back up why you're saying, hey, we're going to cut rates or we're going to lower our restrictions or we're going to hold. You know what I mean? So this occupancy chart is a good kind of place to start. So for the Outer Banks, I just brought this down to 2024 and 2025, and we can see some of the trends that I had talked about being visible at a national level. So Q1, pretty stable, but super low season. So honestly, most people probably aren't noticing or really even paying attention to what's going on there. It's not like a good indicator for anybody of what's going to happen in the future. Once we hit March, we see quite a bit of pressure on March from an occupancy perspective. Some of that is made up in Easter for April. I think a lot of the Carolina markets, and you can correct me, maybe there's something else going on, but it seems like Easter consistently is strong. It's that the demand in the spring is more tied to Easter than it is to anything else. Like in the Panhandle, when Easter over aligns with spring breaks, it's really, really strong, but Easter doesn't carry the ball for them like the spring breaks do. It seems to me when I look at Carolina markets, Easter really is like a really strong driver. You see it actually does. There is year over year increase in April, which is good. It just doesn't quite make up the shortfall from the March previous year. That's an observation I made. Maybe it's wrong, but it does seem like that Easter time period does really carry the ball for the demand that's coming in. But still, when we look across this time period, or even just this time period, we're seeing a net loss in occupancy. We're seeing this occupancy pressure start to kind of like get built into the marketplace. That continues into May. And really here, it continues through the summer. So at the market level, we're seeing pressure across the year in occupancy. Now, this is going to be all properties. Right now, I'm looking at everything from our professional inventory to the non-professional inventory and hosts that we're also observing. And something I think is generally also pretty true is that professionals are performing better. Not only in overall occupancy, because you can see some of these occupancy levels are fairly low compared to what you might expect in your portfolio, but they also tend to be maintaining much better in this marketplace because they're able to respond faster, they're able to respond earlier, they have more tools to respond with. That tends to be true. We heard some of that from Jason, right? He's got early booking windows. Early booking windows probably were really good. If you were able to book early, you have a lot more buttressing against shortfalls in the midterm is really where they're appearing. We see that short-term windows have been surprisingly strong, but they're not quite making up for the fact that that mid booking window has been weak across the country in almost every segment that we look at. As we get into August and September, we see those shortfalls continue. September looked really, really poor, right? We're looking at, maybe a 15% shortfall here in market occupancy. I mean, September's over. It was ended yesterday. That's like down 50%, right, in occupancy. So pretty substantial shortfall in September. This is not unique to this market. I've seen this in pretty much every market I've looked at, is that September looked awful. Don't know what changed. There's a lot going on in the world, but we started to see that around the beginning of August, where there was like a flip across most markets. People were not concerned about the fall, thought it was looking pretty good. We get to around early August, maybe late late July, and we start to see that just flip, where the pacing goes from being like this looks good to this looks bad, or the sales are drying up and people aren't really sure what's happening. As we move into October and November, and these seasons tend to be pretty weak shoulders. Like we're getting into the end of the year here. So I would expect a lot of booking to be last minute, but we are still seeing this pace pretty far below. It's down about 12% in October at the market level right now in terms of pace. It's down about 5% in November, and then booking windows are so short that we're not really seeing any difference in pace through the end of the year. But this September situation in pace seems to be continuing at the market level, right? And given that it's October, we're in a pretty tough, like there's not a lot of time to think it through. I think a big piece of kind of planning for next year, it has to do with putting on the early booking, right? Because there's another trend that we've seen nationally that I think is probably partially true here too. If I pull up 2026, you can see that we actually have non-negligible amounts of occupancy going onto the books already for next year in most months, actually, even in September. So that early booking is buttressing the ability to survive the instability in the mid and short term. And they're booking. And this is a story we're also hearing is even though like the fall is bad, next year's booking is strong. Like advanced booking window booking remains strong. We've heard that consistently from the ski people who give us a little bit of a view into what's going on for next year because they're booking for their high season now. And they've been saying all summer, man, early booking is just we're crushing it, right? It is through the roof. Luxury booking, like really high-end property booking, is doing really, really well. That's something we see in the hotel world as well, as that luxury segment's doing really, really well. Mid segments and low segments are really suffering, right? So like mid-scale and kind of budget segments are really suffering. So there's a few trends there that are pretty interesting. And I think what that means for us, you know, in the short term, probably going to be a battle for occupancy, going to be really tough, especially if you're behind pace yourself. The rest of the market is falling. That means the prices are probably going to collapse. As we look out into November and December, just make sure your price is competitive, right? Just put out the price you're going to be at because there's not a lot of occupancy to go around anyway. It's pacing down. And then as you look into next year, really making sure that that price is set in a way that like you is reasonable, right? There are bookings to be made that can really buttress you if things end up being difficult next year. To be getting that piece of the pie now. That's a little harder, right? I usually tend to suggest to people like look at where your historical averages were and make sure you're within a certain amount of that. I'll pull up some of the rate data and kind of show you. I think our industry has a tendency to really post premiums that are just not competitive to the consumer outside what is otherwise a pretty short time period. And those premiums, I just think, are basically telling the consumer I don't want to sell. But that early booking time period is going to be probably the most significant if you think next year is going to be a difficult year. I don't really have an idea of like to tell you for sure if that's the case. It's been a pretty volatile year this year. I would set your strategy based off of expecting next year to look like this year, though. Maybe not in terms of the same drops, but that it will be difficult or a struggle. Now, I'm going to pull up some of the highest performance data. I do like to look at kind of what the top performers are doing in the market. So this is like the top 20% of properties across the Outer Banks. We see a pretty similar trend here where we see the pressure through the year. They have a little pressure this summer, but overall occupancies are higher and there's not that much, right? So you can see that like something that I said before is professionals tend to be able to maintain better in these environments. Not only are they taking more market share by just maintaining higher occupancies, there's much smaller amounts of loss, right? They're taking more market share. September, instead of being down by half, is down by a third. That's a pretty significant difference. So there is room to kind of do this. And we're also seeing that these occupancies for next year are quite a bit higher. So professionals are taking a higher market share. If you're looking at your own pacing and you're not seeing that, that might mean that you really need to kind of adjust your strategy or think about like where your pricing is. I tend to think that that has to do with like posting premiums too far out. Like a lot of the professionals I'm talking to that have been able to maintain have been a little bit more conservative. We saw that in the market data at the end of 2023. Early pacing was really strong, but actually rates were a little bit down. And that conservatism seems to be working out for especially these large revenue managers when the market seems to be bad. It's kind of I'd rather be in the position where I left a little ADR on the table if things were good than be in the position of trying to scramble at the last minute if things are bad. Okay. I'm going to hop over to this asking rate one. So asking rate's kind of an interesting metric. It is not ADRs, but it is similar. What it is showing us is kind of like average rates that are being advertised in the market. So it includes stuff that ends up being booked or going unavailable, but it also includes stuff that ends up not being booked. And let me put this back up to the all. So it's just kind of like where occupancy is kind of like telling us like, hey, how's the demand doing in the market? Asking rates telling us like, what is the supply doing? How is the market actually responding to what's going on? And in the Outer Banks, we see, I'll draw this line. That's in the past. This is in the future. So we kind of see the ending rate here. Generally speaking, rates are pretty stable. And I see this in a lot of markets that tend to be a little bit more legacy, right? There's not as much adoption of dynamic pricing yet. People tend to set their rates, so it also means they have to expend a lot of resources to change them significantly. Rates just tend to be stable year over year. And I think that actually was a big benefit to a lot of these Carolina markets in the spring where, dynamic pricing will really help because it'll help respond to the low season, but it also gives people the tools to like overprice all the time if they want to. And we tend to see that in the Panhandle where like they overprice the spring because they want it to be higher. Here we see a lot of stability in the rates. There's a little bit of an increase in these high season months, despite the fact that we see occupancy pressure, but it's not super significant. And as we look into the future here, we do see that there are some premiums being held. So the market still does post a premium a little further out, but they are actualizing pretty close to what they're doing. I would say that the market maybe isn't being reactive enough considering the occupancy shortfalls, which is an opportunity for professionals, right? And when we look further out, even though we know that pacing has been poor from September and October, these rate premiums remain kind of stable. So there is some opportunity here where if you're to adjust your rate just a little bit further out or to be thinking a little bit further out, you can probably undercut the market, but there's not as much room as some areas where I tend to see in a lot of markets, people really keep the rate very, very high the further out they go. And you see it really start to jump up. So what's here? This is month 1, month 2, month 3, around 2 to 3 months, you see rate premiums start to go up. That is a little bit the case here. We do see these rate premiums in the market as a whole kind of existing. I think that's kind of a trend just we see in the industry. Like people don't always have the bandwidth or the resources to look out past one season. And so they tend to not be priced. They're not looking for the price that's most effective, like that matches the professionals have an opportunity to really think that through. If you can look out 2, or in this case, I would say even 3 seasons, given how much occupancy is being put on the books for summer, you can really find the competitive price and take that market share early. My short story here is you don't see all the other markets I look at, but pricing looks much more stable here year over year than I see in a lot of markets. I think that's probably because it is a little bit more legacy market, revenue management, but it's also, even though it's more stable, they're not pushing premiums up. We're also not seeing a huge amount of response to the fact that there is occupancy shortfall pretty much across the entirety of the year, especially in the fall. I mean, September was pretty bad. We're not seeing that people are shifting down the fall in response to that substantially. So that'll be tough for you. You'll have to make a decision because technically, like when you're looking at comps, you'd be like, well, we might be in line with our comps. But if nobody's buying any of the comps, then you got to go find what the consumer is going to do. Any questions on that stuff or any thoughts or perspectives? All right. I'm going to hang on these two since we got a couple markets to go through on this one. Just so you guys know, there are a bunch of interesting data points here. We also can bring these down to the daily level. So if you really want to investigate the differences of what's going on or wanted to use this to explain to an owner something very specific, you can access that. A lot of cool stuff. There's, the year over year. So it's a cool tool and it is free. This you can kind of see, is that Easter period, which if we were to break down, Easter remained really strong. In fact, peak Easter had a higher occupancy in Outer Banks. The big difference was it didn't last as long, right? We kind of got, in the previous year, we got almost like 2 weeks of pretty sustained compression. Whereas this year, even though the peak was stronger, it didn't sustain into that second week. All right, so let's hop over to Myrtle Beach. Here we go. So Myrtle Beach. Got another large, pretty broad market area. We'll hop over to the trends and take a look at what the occupancy situation is looking like. So I'll click off 2024, 2020, or 2023, 2024, and I'll come back to 2026. Okay. So we are on all. We are looking at this. And we do see some differences already. The first difference that sticks out at me is Myrtle Beach had much better sustained occupancy. This actually is probably, at a glance, a market that has bucked a lot of the national trends. In that, at a market level, we do see a little bit of that spring pressure, but it's actually gets made up in April. So net, even, maybe a little positive. May is down, but only very marginally. It's like slightly down, right? We see summer here, pretty stable year over year. I think June is down slightly. July is down like barely a point, if that. Yeah, less than a half a point. And so a lot of stability in the occupancy in Myrtle Beach. September, we see the same trend that we see across the country. We saw in the Outer Banks, pretty substantial occupancy shortfall. But this is pretty interesting to me. I would say that this is probably one of the most stable year-over-year occupancy markets I've seen this year across the spring and the summer. Summer, it joins the ranks of like some of the panhandle markets that remain pretty stable, but this spring stability situation is pretty interesting to me. Didn't see that in most places across the country. So Myrtle Beach pacing from an occupancy perspective seems to be pretty good. Now, we haven't looked at rate positions and ADRs. It doesn't mean that people aren't cutting their rate or that RevPAR is down a little bit. But in terms of the amount of people being able to fill nights, that's remained pretty stable in Myrtle Beach. Now, this fall situation, however, looks pretty similar to everywhere else I've looked at. There are shortfalls coming. Now, it's not as bad. October is only pacing down about 6%. So it's pacing down about half is down as all the other Carolina coast markets I looked at. So I pulled up Outer Banks, basically from north to south, Outer Banks to Hilton Head. They're all down about double digits in October. Myrtle Beach is down single digit. So still seeing that pressure across the fall. That seems to be just a nationwide trend right now, but not so bad. When we get into November, obviously these are pretty low months, so we're not seeing too much on the books, but it's down just slightly at 2%. And then as we get into December and January, it's about on par or even slightly ahead. But there's so little occupancy on the books that I wouldn't take it to. I'd take a grain of salt with like any of that as a trend. So Myrtle Beach seems to be quite a bit more stable than other markets across the coast, which is pretty interesting because I can't remember who mentioned it, but someone mentioned that let me see, I took some notes, but please feel free. Betty, I think, mentioned like this is a blue collar market, right? We're talking about these segments that are the most under pressure, right? When we look at macro data. And my hunch here, and maybe we'll be able to dig into it, is that because it's kind of like a drive-in market, it's got a lot of appeal. The demand is there, but the price situation is a lot more competitive, right? This is what I tend to hear in areas where like you have a lot of like condos and apartments that are selling to this segment is, even if the occupancy is there, the people are having to be super duper competitive on the price, right? So you're not necessarily maintaining, it's like hard to maintain your position. But I do think that this is a pretty good sign that this has been able to maintain the occupancy levels here, given how many properties are in this market. But it is kind of a red flag, right? We do know from hearing in hotel data and from other people that this is probably one of the most difficult places to price manage. You have to be very active in your revenue management if you're selling to that segment, because it tends to be the kind of segment that is suffering across a lot of markets. Now, if I pull up 2026, one difference here too, like say the Outer Banks, where we saw a lot of pressure in the short term, but we saw a lot of really strong on the books early out. We don't really see the strength in the early booking here. One, that could be an opportunity. Two, it could be very much related to both the type of product and the type of customer. So while, selling to people in the midterm and the short notice and in that kind of like working class group, them in a shorter booking window, but they're further out, right? They're not taking that risk of kind of putting their money forward and not knowing if they're going to actually take the trip. So we don't see near as strong advanced booking here. When we look at the top performers, I'm going to skim through this one a little bit just because I'm really just looking to see if there's a little difference in trend. Interestingly, we do see a little bit of we see a little bit more of the trend. There's a little bit more loss in the spring, particularly in May. Summer looks about the same, a little bit better performance in September, and October is looking pretty weak. This is pretty interesting to me. I don't know the cause to this. Obviously, overall occupancies are quite a bit higher here, but a little bit of loss year over year is interesting. I would wonder if people are trading down on properties for price, right? Because that's kind of an interesting trend where like, hey, the market stabilized at 40%, but the top performers actually lost a little ground in the spring here. I would wonder if that means that people are actually trading down, like they're buying cheaper properties. They're looking for stuff that's a little cheaper, because in the top performers, we tend to see they have higher occupancies. They also tend to push their rates a little bit better, and you might see people in the last minute trading down. Now, one other trend I've seen across this fall that I think is really important, given that fall is consistently doing pretty poor. This is a trend I've seen in the Panhandle, which is larger homes are really struggling. If they didn't get booked 3 months ago, they're really having a hard time getting booked in the last minute here. And I think that's probably true. Like we're still seeing like condos are able to get filled like, in the week for the week. But those big homes are really, really in a tough spot. And so I think that's a trend that I would expect and carry out through the rest of this Q4 and the beginning of Q1, is really make sure those are competitive for early booking. Because if they're not booked by the time you get to the last minute, you just have such a limited pool of people looking for those that you're competing for, and you really aren't in a position to make it a good deal compared to a smaller property. But that's really in the last minute what you're competing for, right? Is maybe a slightly larger group that's willing to, get the great deal for a home that they don't need. All right, let's take a look at the rate position here and kind of see what's going on in Myrtle Beach from a rate perspective. So this is asking rates again, so kind of like the advertised rates. Let me drop this back down to all. And this is more similar to what I tend to see across the country, which is regardless of whether or not there's occupancy pressure, supply tends to price higher year over year consistently. So we're seeing this is not being quite as reactive as we saw in the Outer Banks. It's not. People are pushing the rate. I wouldn't be surprised if there's more adoption of dynamic pricing in this market. I don't have that data at my fingertips, but we tend to see that when you have a lot of non-home property types as well. You know what I mean? But people, the market is pushing rate kind of consistently, and it's maintaining that into the fall. And it actually starts to increase once you get more than 30 days out. We see that premium start to kind of jump up at the market level and continue to just stack up basically as we go further out. Um, that I think is a really big opportunity for people in this market. It does mean that there's a lot of supply in the market that really isn't focused on making sure that they're competitive to the consumer outside of that short booking window. But it means that pretty much all of their revenue management attention is in the short booking window. So I really advise when we see trends like this, where the market kind of keeps rates at a premium consistently, um, make sure you set aside revenue management time to look an extra season out, because you don't really have to tank your rate. You only have to undercut the competition. And if the competition in average is just kind of pushing a rate and not paying attention until they get within the short window, you can take that little bit of extra market share that can be the difference between maintaining in a difficult environment and falling a little short. In addition, we do see that, the market really isn't pricing competitively for 2026 yet. We also know that that early booking really isn't showing up in this market as much. I think that's a good sign, because when we looked at the Outer Banks, we saw that they have much more stable pricing. Early booking is pretty strong. When we look at data for early booking, we do see that early booking is really strong. So making sure that this price is kind of competitive year round is, I think, a good investment. Especially right now, because we're going into a low season, so there's only so much you can do. Instead of spending a lot of time thinking like how much you're going to cut the rate for the rest of October or November, it's like just cut the rate and focus on making your price reasonable for your budget, but also for the consumer, right? Like, if a good kind of rule of thumb I use, if you check your prices out in these seasons out here, probably from spring forward, if the sum of your prices times your average occupancy is significantly higher than what you would expect out of the listing, you probably have your rate set wrong. Like, you can just set your rate to be a little closer to that, usually within 10 or 15%, is pretty good, and just try to drive a little bit more occupancy without giving up your rate position yet. Um, that's usually something I suggest. It's something that I've talked to a lot of folks about over the years, the last 2 years when things came off of the COVID highs, when people really had big premiums up. Speaking, I still see that the market at large is holding premiums across the board. Now, if we look at the high performing listings, we do see a little different trend, and this tends to also be true. Professionals are paying more attention to what's going on. You don't see the same rate kind of pushing. We do see a little bit of it. We do see people pushing, the market, even at the high level, pushing rate a little bit, but it's much more conservative. It was much more conservative across the spring. We see it's still pretty conservative across the fall, but it's not like under. I would expect it to be under in response to September. But granted, in this market, this is the first time there's been like a really big shock to the market. A lot of other markets started seeing big shocks and saw them continue out throughout the year, so they've seen their prices drop pretty substantially. Example would be like if you go inland into like around Asheville or around Sevierville, Sevier County. You don't see these premiums at all across the market. People are just under what they were doing last year, and they're doing that like 3 to 4 months out in the future. This market's been more stable. We see these still a little higher. We see that people are still kind of, those premiums crawl up as we get into November and December. They crawl up as we get into 2026, even at the high performers. I think that despite this market having done pretty well from an occupancy perspective for most of the year, I would take September and assume it might be a trend, right? Kind of assume that, like, I think you can always react if things start to just like suddenly recover, but you're going to put yourself in a safer situation if things don't recover well, if you assume that September is a trend and just get a little bit more conservative in your pricing plan across the end of this year and into 2026. That one's tricky. I know I'm telling people like potentially like cut the rate. You have to check your own rate position here, because you might not be doing what the market is doing, right? You may already have a pretty reasonable rate plan or be seeing pretty good pacing for 2026. If that's the case, don't just do what I'm saying, but you kind of need to check. So I don't know, like, for anyone here in Myrtle Beach, how is what I'm saying matching what you're saying?
Honestly, I think that's our strategy, is making sure we're not priced at a premium, particularly going into Cyber Week in November, which is when we tend to see a lot of bookings for the summer and the spring. So you're definitely right on the money as far as I'm concerned and what our strategy is moving forward. But it's something we have to constantly watch, because our hope is that we can, instead of being way up here and then having to drop way down, we're trying to start at a little more conservative position and then be able to maintain that, as you know what I mean, and then end up being ahead. That's the hope.
Yeah. And it is tough. I know that I've talked to some large organizations in like Gulf Shores, Alabama, um, that have really early data. Like kind of like you said, they start to see like the next year's data as early as Black Friday, right? Through their like direct and promotions. And sometimes like have taken a pretty conservative approach compared to the previous years, and it worked pretty well for the summer. They didn't feel like they figured it out for the spring. They still ended up having to cut. I think part of that is, spring occupancies across the country caught people by surprise. But I tend to hear from these from the largest enterprise revenue managers that strategy has helped them to maintain, that they're looking out much further. Jason, I don't know that you're being how conservative you're being, but you seem to be looking out pretty far in your portfolio, making sure that that early booking is really buttressing. I mean, you basically said you didn't have to deal with all the concerns of what people were dealing with because you had pretty early booking.
Yeah, and we try to look at it real early. I mean, in December and January, we're wanting to see, pretty good numbers for the summer. And if we aren't, we know that, we want to make adjustments. We try, we would like to make them before the market to try to stay ahead of it, type of a thing. But obviously not too early. So just gotta, dance that line.
Yeah. I think that, as we look at the end of the year, that's probably like in terms of, people only have so much time, right? Not everyone has a professional revenue manager that's doing this 24/7. And even those that do, they're busy too. I would say like if you're thinking about how to spend your mental resources, don't spend too much time on Q4 in the sense that like just put the rate where it's going to be, because if we carry forward the trend of September and what we're kind of seeing in October pacing, it's probably not going to be good. You're probably going to be at a pretty low rate point. Get there early and don't spend a bunch of time agonizing over that, and instead use that time and think about positioning next year now and setting those thresholds like, hey, in January I want to like, this is like a point where we're telling the team we really need to be paying attention of our pace. We want to be pacing ahead for 2026 next year, right? Or whatever. And just spend that time thinking about getting your rate position in. I think there's opportunity in Myrtle Beach, even though we don't see as much occupancy on the books. I think that's partly the product and the consumer, and also partly the rate position. I think in the Outer Banks, it's like really obvious that if you're not taking advantage of this early booking, you're probably putting yourself in a position to fall behind, and that's a much better use of your revenue management time than agonizing over trying to get this occupancy at anything other than whatever the rate's going to be at the end, because it's a pretty low occupancy time period. You know what you're going to do with the rate. Why spend the time every week doing it when you can just kind of put it down, put it where it needs to be, and move forward and focus on this time period that really is, arguably driving more revenue than what's on the books already for Q4 in the market. Okay, awesome guys. Well, I think that's the amount of time. I have some other market reports. So if you had a market area you wanted us to talk about, let us know. We can maybe send you some insights. We'll probably do another one in this region for around Q1. So when we start to hit that beginning of the like primary booking window, we'll do another check-in and talk about what's going on. We'll think about maybe splitting it off so we're not trying to cover so much area. But really appreciate you guys being here and your participation. Just a quick reminder, these charts are really helpful if you need to communicate to owners what's going on. You can export them as pictures. The market reports are free for everybody. If you just sign up and create a free account, you can access a market report anywhere in the country. In addition to that, we do have a really great tool for showing pacing and performance at a very, very granular level. I kind of call it like a key data light, because it's not quite as flexible as key data, but it's really, really certain use cases. And so if you are looking for some tools to help you see what's going on in your portfolio and how you're pacing, let us know. This tool is actually free. All of our business intelligence tools across our platform. So being able to view your rates, being able to sort and filter lists by KPIs, we actually offer those for everyone. We convinced our CFO to do it or a CEO to do it when our CFO was out on paternity leave. But it's a great tool. You can see right now I'm showing occupancy compared to where I was same time last year. It's also highlighting the sales. So I'm selling a lot in November, but I'm still down a little compared to my overall last year. And what's really neat, if you like to get granular about revenue management, you can bring this all the way to the daily level and really spot which days are selling, which days are pacing behind at a super granular level. So if you're deciding where to make changes, you might find like, hey, these dates in December are strong, but Christmas isn't actually selling. So if I was just looking at the December level, I might say, I'm going to up December. It's only the beginning half. I might not actually need to cut the back half. So we're happy to provide training on this too if you want to use it. You can roll it up to any group of properties, so you don't always have to look at just your portfolio. And if you need some extra tools to kind of see how you're pacing, which I think is going to be really key as we go into next year, that pace aspect, we're happy to get you set up on this as well. Awesome. Thanks, everyone.
Thank you.
Thank you.
Appreciate your time.
Thanks, John.